Your investment landscape just shifted. The Singapore Exchange has granted approval in principle for Frasers Hospitality Trust to delist. For many, this raises immediate questions. Why is this happening? What's the real impact on investors? And most importantly, what steps should you take right now? We are diving deep to give you the clarity you need. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Let's understand the why. FHT was set up in 2014 to give investors a slice of the global hospitality pie, with properties in major cities across Asia, Australia, and Europe. But since then, it's been a tough ride. Global headwinds. We've seen a weaker Singapore dollar against other currencies where FHT operates, interest rates climbing, and general cost inflation hitting hard. Plus, big events like Brexit and even the COVID-19 pandemic threw a wrench in things. Performance gap. Even though FHT's hotels are seeing more guests and revenue per room is back to pre-COVID levels, the money paid out to investors, called distribution pay staple security, hasn't recovered. Why? Those higher costs for staff and utilities, plus the stronger Singapore dollar, are eating into profits. Structural issues. FHT is also relatively small compared to its bigger peers like Capital and Ascot Trust. This means it's harder for them to borrow money cheaply or attract big institutional investors, limiting their growth. Also, hospitality trusts, with their shorter guest stays, are seen as more volatile than other types of REITs with long-term leases, making them less attractive to some income investors. So, after looking at all their options, the FHT directors decided that going private with their sponsor, Frasers Property, was the best way to unlock value for unit holders. It's about giving investors a clear exit at a good price. So, what's the offer on the table? Frasers Property is offering 71 cents per unit in cash. This isn't just a random number, it's designed to be attractive. Here's why. Premium to NAV, this 71 cents is a healthy 10.7% premium over its net asset value of 0.63904 Singapore dollars per unit as of April 30th, 2025. Better than peers, the offer implies a price-to-NAV ratio of 1.11 times. This is actually higher than the average for other Singapore REITs that have gone private since 2020, which was around 1.04 times. Good return. For those who bought FHT shares at its IPO and participated in rights issues, this 71 cents offer means a total return of 27.8%. Plus, an independent financial advisor has looked at the numbers and said the offer is fair and reasonable. This whole process is happening through something called a scheme of arrangement. Basically, Frasers Property wants to buy up all the shares they don't already own. For this to happen, at least 75% of the unit holders who vote need to approve the deal. Here's a quick look at the expected timeline. Late July 2025. Expected date for the unit holder meeting where you'll vote. Late August 2025. If approved, the scheme is expected to become effective. Early September 2025. FHT is expected to be delisted from the SGX. Now, let's talk about delisting in general, because it's important to know the difference between a voluntary delisting, like FHT's, and an involuntary one. Voluntary delisting. This is when a company chooses to leave the exchange, often to go private, restructure, or cut down on public listing costs. They usually offer to buy back shares, often at a premium, which is what FHT is doing. This is generally a better outcome for shareholders. Involuntary delisting. This happens when the exchange forces a company to delist, usually because it failed to meet listing rules like minimum share price or financial reporting. This often signals serious problems and usually doesn't come with a buyout offer. So, what are the consequences if you hold shares in a company that delists, especially if it's not a voluntary buyout? Loss of liquidity. Your shares become much harder to buy or sell. Trading might move to less accessible over-the-counter markets. Less transparency. Delisted companies have fewer rules about what information they have to share, making it tougher for you to know what's going on with your investment. Price challenges. It's harder to figure out a fair price for your shares without a public exchange, leading to wider gaps between buying and selling prices. Institutional selling. Big funds that track stock indexes might be forced to sell their shares, pushing the price down further. No new capital. The company can't raise money by issuing new shares publicly, which can hurt its future growth. Brokerage and CPF impact. If you have leveraged accounts, your broker might close positions at zero value. And if you use your CPF money, you'll still pay quarterly fees on those illiquid shares. For FHT, the current offer is designed to give you a clean, liquid exit, avoiding these potential headaches. So if you're an FHT unit holder, what should you do? You essentially have two main paths, with the third being largely impractical in this specific situation. Option 1. Accept a privatization offer. This is the most straightforward. You vote yes at the scheme meeting, which is expected in late July 2025. If it passes, you get 71 cents cash per unit. Benefits. You get a guaranteed cash exit at a premium. You avoid future market ups and downs for FHT, and you free up your capital to invest elsewhere. This is a clean exit from a trust that's faced a lot of challenges. Option 2. Sell shares on the open market. You can sell your FHT shares on the SGX before the scheme meeting. Benefits. You get immediate cash and don't have to wait for the scheme vote. If the market price is close to the $0.71 offer, this can be a good way to secure your exit. FHT last traded at 70 cents on July 11th. Risks. The market price could fluctuate, potentially meaning you sell for less than the 71 cents offer. Option 3. Holding delisted shares. For FHT, this isn't really a long-term option if the scheme is approved. The scheme of arrangement is designed to buy all shares not held by the sponsor. So if the delisting is approved, your shares will be compulsorily acquired and you'll be cashed out. The real risk of holding. This option only truly comes into play if the scheme fails to get the 75% approval, like it narrowly did in 2022. If that happens, FHT stays listed and you're still holding shares in a trust facing the same economic and structural challenges that led to this privatization attempt in the first place. This means continued exposure to illiquidity and potential underperformance. Given the situation, accepting the offer provides a certain premium return now, which might be preferable to holding an asset with uncertain future prospects. So to wrap it up, FHT is delisting because of ongoing economic pressures and its own structural limitations that have made it tough to grow as a public company. The 71 cents cash offer is a solid deal, giving investors a premium exit. For retail investors, the clearest path is to either accept this offer by voting for the scheme or sell your shares on the open market before the delisting. Both options provide a way to realize your investment now and avoid the potential downsides of holding an illiquid asset. Ultimately, this move by FHT sponsor, Frasers Property, highlights a trend in the market where companies are choosing to go private to navigate challenging environments and unlock value away from public scrutiny. As always, if you have specific questions about your investments, it's always a good idea to talk to a financial advisor. Thanks for watching, and we'll see you in the next video.